Hey everybody, Signet here with the Bullish Bears. So in this video we're going to talk about virus style options strategies. Now really all this is the current market has an overly sensitive implied volatility environment right now. And so when products make the slightest move in either direction, the implied volatility is really moving. We can take advantage of this. So if we only stay on the put side, there's two different strategies we can do. We can go long off of support and we can go short off of resistance using just the puts and keeping that volatility on our side. With the debit spread, when the market falls, the implied volatility is going to rise. That's going to make our debit spread make money faster. If we go the other side and we are coming off of support and going long and we take a put spread, when the market goes up, the implied volatility is going to go down, and that's going to make our credit spread gain value faster. You can see here I've got Visa up on the chart. Look at what happened when the market began to move up off of this support level. It got vol crushed. Now this isn't a massive vol crush like what we see in earnings moves, but this does count for a vol crush, and that was a 10-point, almost a 10-point vol crush with just one day. All right, and that's what we're looking at here. We can take a trade where we have almost no ask out of the market, that we don't need price to really do very much at all. But while price is moving and we get the vol crush, we get our trade. Or on the inverse of that, you can see that when the market began to fade off of here from the resistance that it hit, as it faded down for 3 days, the market the implied volatility rose for those 3 days. That again wasn't a very big move in the market, but if you had done a put debit spread, you would have made money in the move, but you would have made more money from the vol spike. All right, so that's all that we're dealing with here. You don't have to worry about the call side at all. We will only be dealing with a put debit spread or a put credit spread. And that's all that we want to deal with. These are strictly volatility moves, and that the direction is going to help. This strategy does not tell you what product to trade. This strategy does not give you direction. You need to already have decided what direction you're going to be trading, and you need to already have decided all the other rules that go into place. All right, so with this Visa trade, if I was to build it at the money, and I would want to use a credit spread because I'm looking to go long, this would be a 1-to-1 risk to reward ratio, pretty close, 2 pennies off. This would be an acceptable trade. Now the reason that I would not personally trade it now, it's already had the vol crush, it's already moved off of its lows, and we missed the opportunity to trade this. We would want to trade it either on the morning of that day or on this day, right? So yes, timing matters. If you've already missed the move, if you're not getting in at support or you're not getting in at resistance, you don't want to take the trade. If you can't get a good 1-to-1 risk to reward ratio, you don't want to take the trade. So, virus style options strategies. First, a little bit of basic options logic. Trade small, trade often. That's not just me who says that. All the biggest firms and all the biggest trading companies in the world say the same thing. And in fact, there's a company called Susquehanna, and they also do this, and they went years without taking a loss at the end of the day. They had losses, but at the end of the day, they were still green. And that's because they were taking a lot of trades, small size. All right, stack the numbers on your side when you're doing these trades. That's kind of the whole thought process behind it. Build the right trade or don't trade the product. So if you put on the trade and you're over here and you're building it and you just can't get a good value for it, that means that the skew is against you and you shouldn't take the trade. You're going to find this often. So when you go in and you look at the options and you can't get a good value, that's because the skew is against you and you shouldn't take this trade. So you won't have to worry about whether or not you should or shouldn't take the trade, or if the option skew is on your side, or if the Greeks are in your favor. Because if you can't build this at the money for a 1-to-1 risk to reward ratio, then it's not a trade that you can take. So the credit crush, we want to use a 20 to 24 day expiration, which is what I'm looking at here, the May 15, 23 days. And we want a 1-to-1 risk to reward ratio, or a neutral trade. And that's what we have here. It's a couple pennies off, but that's to be expected. It could go either way, right? I could have built this and maybe it was for $1.23 and instead we're looking at $1.27. You got to give a little, right? Maybe you could work the order. Maybe you work it some way, try to get your risk to reward ratio. In this example, I'm actually ahead $2 instead of behind $2, right? I'm collecting $2 more. So I wouldn't try to bump it down. I would just go ahead and collect the more money that it's offering. All right. So what credit spreads are for when we are coming off of support. When the market rallies and we get the vol crush, it helps. You can see that this is exactly the kind of thing we want to use on our side. The debit dip trades are the other direction. Okay, we want to take a debit spread to go short, and we want to use the credit spread to go long, and we're only dealing with the puts. No calls is going to be used in this strategy at all. When the market rallies, we get vol crushed, and when the market fades, we get vol spike. That spike is important. That's what we see here, right? So now that we've got all of that covered, you can see the example here. We got a debit dip trade and a credit crush trade. Both of these use puts. We can increase our win rate with this strategy by doing a couple things, and we know that this works, and we also know that we can make more money doing this. We want a 1-to-1 pop ratio, and we want to aim for about 15 to 25% of book. The only time that you want to adjust this number higher is if you're closing the trade on the same day that you open it, because then it starts to threaten PDT, right? We need to not open and close too many trades in the same day. So if you're getting into these trades and you're realizing that, hey, I hit 25% and I need to close the trade, and it's the same day, you got to try to push that target book back. Don't go higher than 50% profit. Now, when you hear me say book, if I collect $1.27, that's my book. If I want to trade this and close it at 50% profit, then it's 50% of my book. I can calculate that very easily. I just go in and get the calculator. Where's my calculator? There it is. So we get the calculator out and we punch in the numbers. We've got 1.27 divided by 2. 50% of book is $63. I could put in my sell or my buy order for $63 to close this trade at 50% profit. Don't go past 50% profit. We don't want 75%. We don't want 100%. We want 50% or less. There's two reasons for this. One, you make more money if you close the trade early and open a new one. Two, you have a higher win rate. So you'll make more money and win more trades if you close it early. Every single back-tested logic for the last 50 years from around the world and the biggest trading firms have all figured this out. Close the trade early, open a new one. Keep the money cycling. Trade small, trade often, keep the money moving. All right? You'll make more money and you'll win more often. So nothing greater than 50% profit. Other things that we can do to increase our win rate is avoid a day chart that has gaps all over the place. Earnings in the next 30 days. Earnings in the past 10 days. any daily chart with parabolic moves and any daily chart that just makes you sit back and say, oh man, damn, this chart's a mess. Hey, that's your instincts telling you back away. Sometimes we don't even have words for what we're looking at on the chart that tells us that it's just not something we want to trade, but we just know. We just look at the chart on a daily time frame and just, oh man, this thing's a mess. Hey, back away. Go trade something else, right? So these things right here will increase your win rate drastically. This is what we call best practices, sticking to what works because we know it works. Don't cheat on this. If it's got massive gaps, don't trade it. If it's been making parabolic moves like crazy with no rhyme or reason behind it, don't trade it. Stay away from it. Right? And then these earnings ones. These earning ones are very important. Credit does not decay correctly when something is going into earnings. So if it has earnings in the next 30 days, credit spreads are not going to do it any good at all. If it just had earnings in the past 10 days, the manipulation in the implied volatility has not gone away yet, and you're still going to be susceptible to that kind of damage. Leave it alone. 10 days is the very peak. So if it's been 8 days, maybe you can give a little wiggle room. But if it had earnings 2 days ago, no, leave it alone. The options aren't going to work correctly because these are credit and debit trades. We need that volatility on our side. That's what this entire strategy is focused on, taking advantage of everything just having an overly sensitive and a highly elevated implied volatility. Let's use that and make some money. Now, even though we're building these trades at 23 days to expiration, we will never hold them that long. If we cross into 5-day to expiration time frame, which is what we always call the front series, it's time to get out of that trade. Win, lose, draw, get out of the trade. We don't want to hold it into expiration. Whether it's profitable or it's a loss, get out of that trade. So 5 days to expiration, 7 days to expiration, get out of that thing. All right. So these trades, they should not be lasting 23 days. We are using 20 to 24 day to expiration, but we never hold them that long. And I think you'll see what I've been seeing as I've been trading these, that you'll be shutting them down between 7 to 10 or 10 to 12 days, right? Half this time or less, and you're cycling out and into another one. If you actually catch the market on its fade in, right? If you had traded long on the day that this had started to pull back, by the time it started to rally the next day, you would have closed it the next day. I guarantee you that quickly you would have already been out of the trade. So timing can get you out of these so quick, you actually have to avoid PDT and hang on to it a little longer, just so you're not opening and closing in the trade in the same day. Now I've been trading this strategy on the charts here using 3-month 60-minute charts, and then finding my entry on a 1-month 15-minute chart. You can see both those numbers written above. All right, that's 90-day 60 minutes, 30 days 15 minutes. These trades are very easy to see on this time frame. You can identify the support and resistance levels very clearly. What I have here is a daily chart, and on this daily chart you can see where the expected move is on the week, and then you can see the daily structure. All right, that's these levels down here. So if you were going along off of these lows with a put credit spread, you would have been done today immediately, just that quick. That's how fast these trades have been going through. All right, so this strategy is a very quick turnaround strategy if you're a skilled trader to begin with. Now, if you're struggling to get direction right, you're going to want to be careful with this. This strategy does not help you pick a trade, find a trade, or get direction right. That's not what this strategy is designed to do at all. And instead, this strategy is to help you choose the right options for the current market environment. So one thing that I would recommend is look at the Bullish Bears watch list every day. Lucian has already done the work and handed you things that could make a move today. So the bias is already built into his analysis. Once you see the trade start to make the move and you are ready to take the trade, you now have an options strategy to use. If we're going short, we use the puts and we use a debit. If we're going long, we use the puts and we use a credit. Just like that, you're good to go. You stick these rules, keep them in mind, and you're going to nail this thing. All right. This is the most simple, basic option strategy you've ever run across. There is nothing complicated to it whatsoever. If you build that trade and you're not getting a fair value for it, fair meaning a 1-to-1 risk to reward ratio, that it's not unbalanced, we don't want to go out of the money. We don't want to be up here where we have an ask or we're not getting a fair value, or it's unbalanced or skewed in some way. They call that an asymmetrical trade. We don't want any of those. We want to be at the money with a 1-to-1 risk to reward ratio or something very close to it. And we want to use these set of rules that I've given here. Now, one thing that I will mention is in the current market, we are in earnings season. So you may find it difficult to avoid products that don't have earnings. Swap over to the ETFs. Normal market conditions, we don't look at ETFs for credit too much because they are normally things that don't move very much and have a very low implied volatility. But in this current market, that's not really true at all. And so the ability to do this strategy in the ETF marketplace helps you avoid earnings and still get really good trades. This is the perfect time to be trading the ETF products that are out there. We do have ETF lists on the Bullish Bears website. And then I've got just a small list in here. I'll pause the screen or just leave it still so you can take a screenshot. You can see we got Japan, Mexico, Brazil, China, Russia, all ETFs that perhaps could give you trades. There's an ETF company called iShares, and those are listed here towards the bottom. We've got a company called Spiders, and they make offensive, midline, and defensive ETFs in a variety of marketplaces. And then we've also got retail, oil, and biotech here. And then we've also got home builders, all from the Spiders company. That is just a company named Spiders. All right, and then we've got index ETFs. Now you're going to want to be careful with index ETFs because of the fact that some of them are really big, right? The INDX, that's a very big index ETF. The RUT is another one, very big, very dangerous. You want to be careful with that. SPX is another one, very big, very dangerous. Other ETFs you can use is perhaps the SMH semiconductors. So let me show you what a bad trade would look like. We're going to just jump over to something like the Qs. And we're going to try to take a trade at the money to go long. So here we are. We got a $1 wide trade and we only got 38 cents. That's not acceptable. That's not close to a 1-to-1 risk to reward ratio. We wouldn't be able to do this trade. Now, could I go out of the money? Could I just even look and see? It didn't get any better. How about this one? Not any better yet. You can see it's just not working, right? So there's nothing here for me. That means I wouldn't put the trade on in the Qs to go long with these puts. What if I wanted to go short here? Could I go short and get a fair value? No. I couldn't even go short in the puts here with a fair value. Right now, in this particular situation, I'm paying $40, which means I have a $60 profit that I could get, and I'm at the money. But I do have an ask here. There is an ask, right? I would need the market to get below the 209. Let's go take a look at this on the chain here. Now, price currently is at 209.92, and I would be losing this trade until the market got below this break even at 209.59. So I have an ask here. I need it to move down. Does that mean I can't take the trade? No, but I need something out of the market if I want to do this. So if I wanted to go short here with a debit, it's not a one-to-one. So that means there's an ask built into it. If this looks acceptable to you, that you're willing to take the trade because you can see that it's a small ask, it's not too much, perhaps this would be a trade you'd be willing to take. If we had built it and the trade was for 60, we absolutely would not want this trade, because that means we're paying 60 and we only have an opportunity to make 40, and that won't work. Okay? So if they are unbalanced, if they are skewed like this, you want to make sure that it's skewed in your favor. Now, what this pricing tells me and why I wouldn't want it is they're saying, sure, here, take the trade. We'll offer you more money if you take it. They would only do that if they have skew pointing to the fact that they're expecting a rally in the market. And I'm trying to go short, which means I wouldn't want it unless I'm really sure that it's going to go down here. Okay, so with the debit spread, you go short. With the credit spread, you go long. Make sure that you're getting a fair value for it. You want a 1-to-1 risk to reward ratio or better on your side, right? And this would be better on your side. But you have to ask, why are they willing to pay you more to go short right now? Is that because the skew is implying that everybody believes this market is going to go up and you're the only one looking to go down? Don't let that fool you. Sometimes, more often than not, a good trader can recognize it's time to go short and can come in and get the trade at a very great value an hour, 2 hours, 3 hours before the market does start to go in that direction. A lot of us trade that way. We run contrarian. We find a market coming up into a zone like this, for an example, and we're ready to go short against it, seeing that we're running into that zone, right? And if we look at those options and we see such a great trade value as we just saw there on the options chain, heck yeah, take that thing, right? You can get it for $40. You're getting better than a 1-to-1 risk to reward ratio. You're going to risk $40 to make $60. Yes, take that trade. But you're getting in early, right? You're getting in when the market's still rallying up. That's what you want to do. That's exactly what you want to do. All right? So you have all the keys and all the parts and all the pieces to this strategy now. This is the credit crush trades and the debit dip trades. These are virus-style option strategies. I don't know what else to call them, so I'm naming them that. Therefore, I'm just going to rubber stamp it and say it's mine. That's what I'm calling them. This is what we're going to do with these. Now, I've been running these, and they're working really good for me, but they are not going to give you direction. Okay? They're not even going to help you find trades. After you've already decided that you want to go long or that you want to go short, you come in and you try to find the pricing, the good pricing that is not skewed or countered or asymmetrical. You guys, you got it. That's the long and the short of it right there. Everything that we needed to cover has been done, and the video is less than 25 minutes. Knocked that one out of the ballpark. Hey, I appreciate your time. Make sure you stop by the Bullish Bears Next Level Training Library and watch the Greek neutral strategy. That has the same kind of logic built into it. It just isn't specific to puts. It talks more in depth about this 1-to-1 risk to reward ratio at the money style trading, and it could maybe give you some more background on what we're doing here. All right. So I appreciate you, and I look forward to seeing you at the next video.